Hi folks, welcome to this video related to Module 1, whereby we are going to do a little case analysis. Now, case analysis is not a huge part of our course, but at the beginning and in the first module and the last module, we pay a little more attention to it. Now, the reason we're doing this is just to make sure that you have a good recollection of some of your prerequisite knowledge coming into our course. And what I thought I would do is take a case from your textbook. So I've indicated what it is there, case 1-5. And again, I just wanted to make sure you knew that this format, and I think you can see, it's not a case format per se. But the reason I set it up this way is because a lot of times it's mostly a problem for students to be able to identify case issues and then write down what the appropriate treatment is for that particular issue. So I thought what I would do is just present you with a little table, one column for issues and one column for the treatment or how to deal with that issue, just to enable you to organize your thoughts so that when you do produce a memo, a business memo, you know exactly what the issues are and you all have already thought through the proper accounting treatment. So if I were you, I would use something like this as a guide and to make sure that you've got all the issues and you have the appropriate treatment. So now about our case, we have a case, GPL. It's called Gold Products Limited, GPL. It's a private company planning to transition to IFRS. The analysis and recommendations are required for the accounting related issues, such as convertible bonds or debentures, unusual items, those items not occurring frequently in business, revenue recognition contingencies like contingent losses, and impairment. So when you read through the case, again, the about the case section, you won't get that, right? So you have to read the case, and you may need to read it a couple of times so that you understand what the issues are. So in this instance, I've tried to do your reading for you. And so if you feel that you want to print the script first, which is what I'm recording from your course, and go through the case yourself to make sure you've got stuff, that's good too. But in any case, some students like to do that and just read it on their own. Some students like to read the case, have it with them while they're going through the script, which they've printed, and do it that way. But it's up to you how you get the content and how you analyze it. But in this particular case, we know that the company, GPL, has some long-term debt on its books, and it was convertible debt. So it's convertible at the investor's or the lender's option, according to the text case. And the issues associated with it, if you look at the note to the statements, is the recording of the long-term debt. It seems to me that they didn't record the conversion option, which is the right to convert, the investor's right to convert the bonds into shares. Right? So we learned in intermediate there's a special accounting treatment for this, and that might not have been taken into account by the looks of it on the statements. And also when the company was issuing the debt, there were transaction costs. Now in my case, what I've done for you here, I've just given you examples of what some of the transaction costs might be. I'm saying, they could be underwriting charges, commissions, legal and accounting charges, printing, registering the document or the bond contract, and promotion cost to promote so they could sell the bond. But the idea is the costs are being paid by the issuer, okay? And what they're doing is they are setting them up as assets. So it says here, are the fees that are being charged under these transaction costs, is it correct to set them up as assets, yes or no? So let's look at that. So what I've done is I've gone through the CPA handbook and I've looked at the sections that are relevant. Now, when you're doing a case for me, I don't expect you to quote or memorize the CPA handbook, but I do expect that you would know what the handbook says on these issues and be able to identify an issue and know what the correct treatment is. So what I'm doing is I'm quoting the sections of the handbook in case you want to go back to it. And again, if you want to go back and check it out yourself, these sections are there. So again, looking at the treatment for the bond with the conversion option, you have to account separately for the conversion feature. So under ASPE, because our company is private, under Section 3856 Part 2 of the handbook, it does state that the issuer of the instrument shall classify it with its component parts as a liability or equity in accordance with the substance of the arrangement. Specifically, the issuer of the financial instrument, in our case the bond, that contains both a liability and equity component, which ours does because the investor has the right to convert it to shares. So they paid based on the fact that they had that option to do it. It says they have to classify the instrument's component parts, that's the debt piece and the equity piece, in accordance with 3856.20, right? So what's the best way to do this? So in dealing with the conversion feature, which is this guy here, right? The easiest way to do it is to figure out what the bond on its own without the conversion feature would be trading at in the marketplace, right? And calculate the present value or discount the stream of future payments of interest and principal. So to me, that's the present value of the bond alone. Compare the present value of what I call the vanilla bond, just the bond alone, to the amount of the proceeds that the issuer, GPL, received from its lenders or investors, right? What was the amount of the proceeds they got? The difference between the cash proceeds that GPL received for the convertible bond and the present value of the vanilla bond without the conversion rights, whatever that value would be, that value or that difference is going to be the value of the equity piece. And they would have to show that as a piece of contributed capital in the equity section. So that would be the best way to divide it up. Now, let's deal with the transaction costs. Now, currently, GPL set up $70,000 in other assets, and they're going to amortize it using the effective interest method. Well, it's not an asset. What they're supposed to do is these costs are being paid by the issuer, which is GPL, and it has to reduce the net proceeds or the cash that they received when they issued this convertible bond, right? It has to it has to be debited, right? We have to debit that. So it's going to reduce the proceeds, the debit to cash, by the amount of the transaction costs. All right. So in our case, it says here, GPL needs to include the costs in the amount determined for the debt, right? That's the cash you get. And then they have to allocate, after they allocate the pro rata portion to the equity conversion feature. So you already have to know when you're setting up the entry at the issue date, how much you're going to set up or charge to the equity piece. So this cost would be treated similar to a discount on the bond payable. Don't forget, discounts have debit balances, right? Discounts on bonds. And so would your transaction costs have a debit. The only thing is you'd amortize it over the life of the debt, okay? And you would actually take in that cost of the transaction costs as part of your interest expense when you amortize the discount, right? So the interest expense is going to include not only any amortized discount, but also some piece of that transaction cost. So it's going to get amortized over the life of the bond. All right. Now it says here that you can use the effective interest method or the straight line method. Don't forget, if they're thinking, because it does say in the case, they're thinking of flipping to IFRS, they'd definitely be using the effective interest method because that's the method that exists under IFRS related to your studies in bonds. You may know this from your prerequisite course. So that kind of deals with the convertible debt issue. Now, let's deal with the revenue recognition issue. It says here that the company has title and risk of loss transferred once the balls were shipped. That's our question. Has the title and the risk of loss transferred once the balls are shipped? That's the product. It says the customer has a right of return until November and only has to pay for the balls once they're sold in November. So the question is, has GPL actually earned the revenue that they booked? Because they booked $900,000 in revenue this quarter. So have they actually earned it? So we have to know, since they're following ASPE right now and they've booked the whole $900,000, does GPL, have they met the standards for revenue recognition which would allow them to book the full $900,000 in revenue if they have. So let's look at it. So here what I did is I went to the ASPE, or Part 2 of the CPA Handbook, checked Section 3400.05, and it says, in a transaction involving the sale of goods, performance shall be regarded as having been achieved when the following conditions have been fulfilled. The risks and rewards of ownership have been transferred to the buyer, okay? And reasonable assurance exists regarding the measurement of the consideration that will be derived from the sale of goods. Well, don't forget, these people can actually return, okay, the goods, and they have a deadline by which to return them, which is sometime during that quarter. So, or after that quarter, I think. So the idea is we need to look at these two criteria and see if we think, based on the way GPL's managing this transaction, if they've booked revenue correctly or not. And I say they haven't. Here's why. First of all, if you look at B, does reasonable assurance exist regarding the measurement of the consideration? That's the money that GPL is going to get from the sale of these goods. Well, don't forget, they're booking their revenue full, $900,000. For the quarter ending September 30th, but these guys can still return beyond that point. So that in November. So I would say they really don't know. They don't really have reasonable assurance regarding the measurement of the consideration because these guys can return it. So I would say definitely I would question whether B is met, right? So it says here, they may be confident, I think in the case they use the word confident, that the balls will sell out. So they're not really concerned with balls being returned, right? There's really nothing to guarantee it. So since the number of balls that are actually sold is linked to the success of the tournament that they describe in the case, we don't really have any reliable information on what the sales number will be at that event, all right? In addition, because this was a special shipment for GPL, we don't even have any prior history with this customer and event. So we don't even know what the likelihood is that they're going to pay. They don't give us any information in the case. Now, the other fact, and it relates more to A, is that the customer doesn't have to pay for the balls until November, and they can return any unsold balls. So it's really questionable whether the risks and rewards of ownership have even been transferred to the buyer at this point. So I don't think either A or B, to my satisfaction, have been met. So I would say GPL shouldn't record the revenue in the quarter. They should wait until the risks and rewards of ownership have been transferred and they have stronger reasonable assurance of what the revenue is going to be after that November month has come and gone. All right. Now, they may wish to include information regarding this as part of the summary highlights or in the notes to the statements for the end of quarter one, which ends at the end of September of this year. But again, they might want to say that they have this sale outstanding, but they haven't recorded the revenue because, again, these conditions weren't met, and say why they thought they weren't met. But in terms of putting them in the revenue and the income statement, no, I don't think so. So that's a second issue. Another issue that was mentioned was a lawsuit contingency. So they said there they have estimated, there was a lawsuit from a customer, or from a supplier, I should say, and they think that the likelihood of losing is 75%. The supplier's suing for $800,000, and if we lose, the issue is the legal department believes that they'll have to pay the full amount of the claim, which is $800,000. So we think, GPL thinks, the court proceedings will be resolved by the end of the fiscal year, which means we still have another 3 quarters to go after September 30th, right? They've decided to accrue a quarter of it, or 25%, or the first quarter of it now, right? Which is $150,000, because they're looking at 75% of the full 800,000, which is 600,000. So they're going to accrue a quarter of that now for the end of September, and then again every quarter, the remaining 3 quarters, another 150,000, so that a full 600,000 would be accrued by the year end. Well, if you look under ASPE, and I've done the looking, under section 3920.12, it requires that a contingent loss be accrued when its occurrence is likely and the loss can be reasonably estimated. Well, yeah, we know it's likely and we know the loss can be estimated. But the question becomes, how much should they accrue? It says that a loss should be accrued when the occurrence is likely. But how much should we accrue? Well, guess what? It says here, the outcome appears to be likely at this time. We know that. And, this is just something that I kind of know from working for private enterprises. And again, the company can set its tolerance level where it wants. But likely in most ASPE organizations is greater than 70%. I've seen it 75, 85, even 90% likely that there's going to be a loss payout. But again, on average, I've seen around 70. But because the occurrence is determinable, the entire potential legal claim should be accrued. Because it says here that the company thinks they will have to pay the claim in full, right? They're saying it's just over 75%, but if they lose, right, they think they may have to pay in full. So there's nothing here that indicates you should be accruing only 75%. And again, even if we use the threshold of 70%, right, the likelihood of payout is there. It's at least 70% likely that the payout will be made. So from my perspective, I think they should be accruing the full $800,000, right? And they should be accruing it now in the quarterly statements for the quarter ended September 30th. Where did they get the idea that they could smooth it out over each quarter, right? I mean, by the end of the year, it'll be all shored up, but they shouldn't be smoothing it. We don't do any smoothing kind of activities. Not ethically, we shouldn't be doing that. So we should be booking it at the time we know that we have a contingent loss, the occurrence is likely, and the amount can be reasonably estimated, which they told us here. We think we're going to have to pay the claim in full, and it's $800,000, and it's 75% likely we're even going to have to pay. So that tells me we should be accruing the whole thing now, at the end of September, not just $150,000. All right. Now, in fact, just as another comment here, even under IFRS, they're even stricter. They would say if it's more likely than not, you have to accrue. More likely than not is anything over 50%. So again, these guys are thinking of going to IFRS. So they need to make sure that they're pretty lily white under ASPE before they make that transition, right? Now, we also have an item that they talked about in the case. They talked about it, the loss due to fire. That's an unusual item. And again, they're showing it as a separate item you can see on their statement of income. And that's the correct treatment, okay, to show it as a separate line item on the income statement. In fact, if you go to section 1520 of part 2, which is for ASPE, paragraph 4, subsection M, it says that the income statement section, it says it requires that revenues, expenses, gains, or losses resulting from transactions or events that aren't expected to occur frequently over several years or don't typify our normal business activities should be shown separately on the face of the statement or disclosed in the notes to the statements or supporting schedules. Well, so this is really saying you could just disclose it in the notes. That's fine with under ASPE. But they're going one step further and they're actually showing it as a line item. Well, I would say I would leave it like that. I wouldn't say, well, you only have to disclose it in the notes, because don't forget, they're considering moving to IFRS. And under IFRS, if you looked at IAS 1, there's a paragraph 85 that says, an entity shall present an additional line item, heading and subtotals in the statement of comprehensive income and income statement when such presentation is relevant to an understanding of the entity's financial performance. So if a company thinks that that's kind of relevant to know we had a fire, if we've lost anything substantial, you're going to have to show it as a line item anyway under IFRS. So the fact that they're doing it now under ASPE, even though they could just default to disclosure, is good, and I would recommend we stay with that. Now, the fifth item I saw here is they recorded $160,000 asset impairment, all right? So it said they had an impairment issue, but it's not really clear to me how they're dealing with the impairment issue in terms of testing and measurement. So how did they test for impairment, and how did they measure the impairment loss? And since they are planning to move to IFRS, know that the impairment testing differs under IFRS. So again, they did say that they wanted to know, the client GPL that is, did say they wanted to know how the standards might be different if they transition from ASPE to IFRS. So I'm going to try and do that here. So here under ASPE, it says we test for impairment when there's a triggering event or a sense or something that's come to our attention that indicates the asset might be impaired. But the requirement for testing is a little more passive than under IFRS. Under IFRS, you do impairment testing. You may be doing it a lot more frequently than annually. But in any case, if you look at the ASPE section 3063, it first compares the carrying value to the recoverable amount, and recoverable amount is calculated based on undiscounted future net cash flows, which is cash flow in and cash flow out from that asset, what you predict it will be. If the carrying value is bigger than that recoverable amount, which is your undiscounted future net cash flows, then an impairment loss is computed, and it's the difference between the carrying amount and the fair value, and there's no reversal of the impairment loss. So again, we don't know how we calculated that amount, if they even know they can't reverse an impairment loss, and what tests they did to come up with the fact that there was impairment. So I'm just taking the time to explain to them under the current reporting requirements for ASPE, that's what it is. Now under IFRS, impairment indicators need to be assessed at each reporting date, which is at least annually. And IAS 36 computes impairment losses as the excess of carrying amount over the recoverable amount, which is the higher of fair value less cost to sell and value in use. So the loss also has to be reversed if there's been a change in estimate used to determine the recoverable amount since the last impairment loss was recognized. So again, under IFRS, they have some very stringent requirements as well. So since this company is thinking they might go to IFRS, I think it's important that they know. Now, if you were looking up under IAS 36, and you'll notice it says here, under IFRS, you reverse an impairment loss when there's been a change in estimate used to determine the recoverable amount. I didn't type it in here, but that's in section 114 of IAS 36. So if you wanted to go in and have a look there, you can, if you wanted to see where I picked that up. So again, there is potential for them to be able to reverse some of this $160,000. Now, in conclusion, based on the differences between the two sets of standards, under IFRS, our first quarter statements would have required us to assess the recoverable amount associated with a piece of equipment, and perhaps we could reverse the impairment loss of $160,000 that we recorded or part of it to better reflect the estimated value of the equipment. Because again, if it's going to have, it says here, I think it said somewhere in the case, that because they located a critical part of a critical piece or critical part needed to make the equipment more serviceable, that might increase its revenue generating potential or its useful life. So if estimates have changed, maybe they can reverse some of that $160,000, right? So they need to consider that if they're moving to IFRS, right? But under Handbook Section 3063 under ASPE, if they're just thinking of ASPE right now, they're not doing any reversals. They're not allowed under ASPE. All right? So see how I kind of balanced both of them. If you're looking to go to IFRS, the testing, whether or not you have an impairment loss and how you calculate it differs under ASPE than it does under IFRS. And again, under IFRS, some reversal is allowed, but under ASPE, no. So again, I tried to sort of show both. Now, earnings per share is important because you'll notice here in the income statement, they didn't calculate an earnings per share, but don't forget under IFRS, you're gonna, right? And in fact, you'd not only need to do a basic, but you'd also need to do a diluted EPS because you have convertible debt. So what if that debt, what if the lender or the investor, what if they had converted? That would mean you'd have more shares out there, 200,000 common shares out there, and that would change your weighted average common share denominator calculation for your EPS calculation. So again, you just have to be mindful that that's another difference you'd have under IFRS. You would be recording a diluted and a basic EPS. And again, EPS isn't a requirement under ASPE. So now I guess the last issue I might mention is just some basic changeover issues, right? So the changeover issues to IFRS, if and when they decide to transaction, it's going to affect not just their accounting policies and the composition of the financial statements, but they're going to have to think of a lot of other things. They're going to have to think of their tax calculations. They're going to be different, right? Even internal controls and processes for finance and other areas. Revenue recognition. It's even more strict under IFRS. I didn't get into all that, but you can go look that up. Under IFRS, it's much stricter too. Internal controls as well. How are we testing for impairment? What are the trigger points for us to know? Under ASPE, we have them, but when we're looking to assess impairment, what are we looking at? Are there controls in place to help us assess impairment under IFRS? And even look at executive and employee compensation plans. Because, if you decide to offer options to your executives, there's specific treatment for those things under IFRS. And again, training your staff. And even doing manuals. There might be some things, we test for impairment when these particular things happen because we're following IFRS. You have to tell your staff what to do and what we need to look for to assess impairment. So again, any revisions to disclosures and procedure manuals due to enhanced disclosure requirements under IFRS might also be required. So this is no easy thing to do. So they're going to have to make sure that they plan for an assessment of what needs to change if they move to IFRS and what they need to do. So they need good project management here so they can set a definitive time frame as to when they'll be ready to make the full transition to IFRS, if in fact that's ultimately what they decide to do. So you can take all of these issues along with the explanations and put them in a memo. All right, that's what I would do with this. And you can do the same for the discussion board that you have this week with your group in order to make sure that you and your group members have come up with all the issues that need to be included with an appropriate explanation, and then use that as the basis upon which to produce your memo. So I hope you found this helpful. I know it's a bit long, but you know what? It's probably good that you go through it, right? So that you know. So again, I hope you found it helpful, and good luck with your assignment.